All right, welcome to the first episode in a multi-part series that I am calling the Architecting of Bitcoin Credit Markets. Now, if you're watching this video, you probably already have a baseline understanding of Bitcoin. You understand that Bitcoin is money and that it's a financial tool for freedom. And you may also be aware that Bitcoin already has some form of very simple Bitcoin-backed credit products. For example, you could take Bitcoin, you could post it as collateral, and you can borrow dollars against it. But if we compare these kind of very simple Bitcoin credit primitives to more sophisticated credit markets of other high quality assets, there's a pretty significant gap here. The Bitcoin side, while it is growing rather quick, it's still relatively small. And the economics of it, especially for the end consumers, usually are not very good. The other thing I'll add is that the underlying infrastructure or the financial plumbing that typically allows credit markets to really scale, gain mass distribution, and gain huge amounts of liquidity either just don't exist for Bitcoin or are kind of a bit clunky and still immature. And so the intention of this whiteboard series is really kind of map this territory. It's to show what currently exists for Bitcoin backed credit products, what are some novel architectures that are maybe coming to market soon, and then really to kind of discuss like how far we can push the limits of Bitcoin backed credit. Like how far can we really take Bitcoin as this pristine collateral asset and embed it deeply into global credit markets. And the way that we're going to do this is we're going to break this series into 7 parts. The first episode, which I'll be doing this whiteboard today, is just going to be talking about Bitcoin credit fundamentals. And it will also kind of foreshadow some of the financial concepts that we'll later talk about in other chapters. Chapter 2 is going to explore the kind of state of DeFi and kind of share like what were genuine innovations with DeFi and then where it's kind of reached structural limitations. Chapter 3 is going to discuss some like new novel kind of on-chain DeFi architecture that hasn't yet been released, but that is coming. Chapter 4 is going to discuss some of the financial plumbing that people don't always see, things like securitization and secondary markets. Chapter 5 is going to take a very honest look at where the trust assumptions exist in these on-chain credit architectures. Chapter 6 is going to discuss a lot about user experience and distribution. For example, how do we kind of create mass distribution for Bitcoin-backed credit products for the radically self-sovereign non-custodial person, along with the person that says, hey, I really want to use the fintech app or the banking relationship that I already know and trust. And then Chapter 7 is going to discuss a lot of the end state for Bitcoin-backed credit and where we think it could potentially go. Okay. So we could probably get into the first whiteboard now. I'll give a quick overview. Up top, we're going to describe just kind of a basic Bitcoin-backed borrowing setup that I think a lot of people may already have some familiarity with. We'll then kind of share some of the financial plumbing and the financial engineering that happens behind the scenes that people don't often see. And then we're going to share how that ties into global dollar markets, what's known as repo, which underpins all financial activity in the entire world. Once you have this kind of big, large map, it will really make it a lot easier to lay out some of the future chapters. All right, so let's go ahead and get into it. We're going to start with a very basic example here of a very common thing, which is that somebody has Bitcoin, they don't want to sell it, and so they want to borrow dollars against it. So we're going to say that we have a borrower here, and they're going to take their Bitcoin and they're going to post it as collateral. And then there is some sort of lender here that says, hey, I have dollars, I'll lend you I'll lend dollars against your Bitcoin collateral. This is really not that novel of a concept anymore. There are lots of companies that do this. Some credible ones include like Unchained Capital, Strike does this. Ledin, of course, is a huge one. You have Coinbase. You have up and coming brands like Lava Loans. You have DLC style loans from teams like Ligos. Like there's a lot of different solutions out there. The thing that all of these companies ultimately share are 3 kind of like core primitives to make Bitcoin-backed borrowing work. The first is some way to lock in the BTC for the life of the loan, so the collateral stays put, securing the loan. The second thing is you obviously need some sort of source of dollars. Here we're saying it's just coming from the lender. And then the last thing is you need some sort of liquidation infrastructure. And so what's happening here is the borrower is posting their BTC as collateral. They're locking it up. They're opting into this liquidation terms that say, if the loan is at risk of becoming under collateralized or I don't pay back the loan, you as this lender or this liquidation infrastructure can sell that Bitcoin collateral to recoup the dollars, ultimately giving the lender back all of their principal plus the interest. So for the life of the loan, the borrower here receives the dollars. Okay. This is what most people kind of understand how Bitcoin-backed borrowing works. Additionally, there is another part of this, which is that the lender has to receive some sort of claim or some sort of evidence supporting their dollars. It could just be that the lender lends, say, $100 to Alice. Alice signs a legal agreement, and that agreement represents basically like an IOU, that the lender receives. Again, this is like their claim to the loan. Maybe if you're doing DLC style loans on chain or some sort of like on chain DeFi strategy, there's like a cryptographic claim that gives you the right to to essentially secure your dollars. And so this is very important because this IOU exists for the life of the loan, and this is an asset that is held by the lender. And so as the lender kind of keeps originating more and more of these loans, maybe they lend $100 to Alice and then Bob and then Carol and so on, they kind of create like a stack of these IOUs. Okay. And again, these IOUs are assets that the lender actually holds on their balance sheet. And the reason this is important is because you can use those assets to reuse and recycle more capital. And so this is a blind spot that I think a lot of people don't really understand. The lenders oftentimes are not just holding these IOUs and collecting the underlying interest and saying, great, like I'm just going to wait for this loan to pay off. In the interim, I'm going to make some interest. A lot of times they're doing financial activity with these IOUs to improve their lending operation. And so specifically, this lender here, I don't care who it is. I don't care if it's Tether and they have hundreds of billions of dollars. This lender is always looking for more efficient ways to amass more dollar liquidity. Okay. Because then they can, maybe lend more dollars to borrowers at lower interest rates or longer maturities, and they can just amass more of that Bitcoin-backed borrowing business. And a very, very common strategy that these lenders do is they take these IOUs, which are assets, and they could do two things with them. One is that they could just sell them. Okay. Because when a lender originates a loan, maybe they make an upfront fee. They just collect a fee and pocket it immediately. And then they say, hey, I will sell the underlying interest to someone else. And that person will give them dollars so that they can relend this and maybe collect another fee upfront. Okay. Or they could actually borrow against this. Okay. So they could post these IOUs as collateral. And maybe they say, here's an asset that's earning 10% interest on fixed terms, fully backed by Bitcoin. And a lender says, great, I will lend you dollars at a variable interest rate. So maybe that's 5% against that collateral. And so that makes a lot of sense because they could lend and collect 10%, borrow against it at maybe 5%, and then collect the spread and kind of loop this style of strategy. And so there's a couple things that I want to clarify here. This process of kind of taking these loans and making them assets or these IOUs that could be then, packaged and sold or borrowed against, this is basically securitization. Maybe you've heard of that term. The second thing that I really want to hammer home is this is not rehypothecation of the Bitcoin collateral whatsoever. That's like a very taboo thing in the Bitcoin world where people are very worried that if they post their Bitcoin as collateral, that the lender is essentially taking that collateral out and maybe, borrowing against it themselves, or they're, lending it out, or they're just doing some sort of activity. That is not what's happening. The BTC collateral is locked. You could have some sort of custody arrangement where this guy, the borrower, holds like one of the keys. You can verify it on chain. The Bitcoin collateral is not moving. But what is being used and financialized is the IOU. It's the claim that represents these loans, not the underlying Bitcoin collateral. Okay. Very, very important. This is not rehypothecation of the BTC collateral asset. Okay. So with that in mind, we have to say, like, who is the entity that essentially is providing dollars to either buy these IOUs or to lend against them? There could be a lot of different entities, go by different names, but for now, I'm just going to call it, a credit facility. Okay. And the IOUs are essentially sent over to this entity. If they're buying them, then they would actually own the IOU assets themselves. And then they would, send dollars over here. Of course, if they're just like, if they're just lending dollars, they would take the IOUs as collateral, but not actually own them. But this is kind of a way that the lenders up here access more dollars. So then you have to ask the question of like, well, where does the credit facility get money? And the credit facility may get its money from, you know, a bank. And so um, the bank will send, dollars over to the credit facility, and the credit facility says, great, like we'll provide collateral, maybe in the form of like corporate bonds. And the bank says, okay, I'm really cool with this collateral. This feels safer and more secure than anything else that's going on here. So I'll send you dollars. Then you have to ask the question. It's like, well, where does the bank get the dollars? And this may be obvious, but the bank will get its dollars from maybe numerous sources, several sources, but a major one is like depositors. And the bank says, hey, we're a bank. We want to be very safe and very secure with our borrowers' money. So we're going to take these dollars and put it into the most risk-free possible thing that we can imagine, which is US Treasuries, right? Lending money to the government, you expect them to never default. That's just going to be seen as the most secure thing to do with customers' deposits. So the bank will actually buy US Treasuries right here. But even this bank, just like the credit facility and just like the lender, the bank wants more dollars. Everybody always wants more liquidity. And so the bank can actually go and take these US Treasuries and they can post them as collateral in something that we call the repo market. And the repo market could then give dollars up to the bank. And so the repo kind of represents like the base layer of the entire global dollar financial system. It's kind of like the God tier sanctuary of where dollars can go and they can feel the safest, that there's like minimal to no counterparty risk. And so the repo market deals on the order of magnitude of trillions of dollars. And so when we think about this setup here, whether it's Bitcoin backed borrowing trying to connect to repo, or it's auto loans or mortgages or, small business loans, everything kind of works in this kind of pyramid where you have US Treasuries is seen as like the most pristine collateral in the world. And that is kind of the way that maybe the next layer down funds itself, which is like banks or how they kind of finance themselves. Okay. And then maybe the banks finance the credit facility. And then maybe that layer funds the fintechs. Okay. And so if you are looking at this, you're probably saying like, why the hell does any of this happen? Like, why do we have so many layers in this like financial plumbing? It just feels like overly complex and it introduces like counterparties and intermediaries and risk. And that is all 100% true. But really, it just comes down to a difference of preferences, right? Like the borrowers have a different preference than the lenders. Like the borrowers in this case may say, I want to post this asset, Bitcoin, as collateral. I want to borrow at like a fixed interest rate and a fixed maturity. And then the lender of repo, which is like the biggest God tier source of dollars, will say, well, hey, that's really cool. But like we will only accept what we perceive as the most pristine collateral, which is US Treasuries. We'll only lend at these kind of variable or what's called this like overnight interest rate. And if you want to access our dollars, like this is the package, this is the deal that we're giving. And so this entire financial plumbing process it's just kind of saying, how do you take something that borrowers demand and you transform it into some sort of form or collateral that maybe a bigger pool of liquidity will accept, like a credit facility? And then how do you transform that into something that maybe like a bank will accept, which in this case we said with corporate bonds? And then how does the bank, transform that into something that repo will ultimately uh, accept? And that's how this financialization naturally starts forming in these credit markets and this financial plumbing and all this stuff starts to work. And so very often when we're kind of debating about Bitcoin backed borrowing or Bitcoin backed credit or like what's a better solution, we're very focused on the origination. We're saying like, oh, this entity has a better solution to custody your Bitcoin, or this one has a better liquidation infrastructure, or like this one is backed by a huge bank and they have dollars. But this ability to kind of recycle these loans um, and to connect the financial plumbing into the deeper repo, like this is really the kind of secret sauce that creates like robust, sophisticated credit markets that can, mass scale. And so, as we go throughout this whiteboard series, we will look at kind of this origination factor. We'll say, are there architectures that we can have that can improve each one of these? But then we'll also kind of consider like, how can these architectures tap in or create some sort of similar financial plumbing that, to be clear, does not introduce like the clear counterparty risk or the opacity of the legacy system. And these will kind of be the two focuses of the rest of our series. But by the end, we'll kind of have some fun and say, like, is there a hyper ambitious future where we can create such credible, Bitcoin credit assets that they could be on par with something like the US Treasury, where they could be perceived as having such low risk and such ability to amass deep liquidity that they could function almost as their own repo market, where the trillions of dollars could see these Bitcoin credit assets as the base layer of the entire global credit system. In that world, you could have these things like, Bitcoin-backed credit that underpin the entire global economy. Those are the types of assets that banks will hold to fund themselves. Those banks will then use that to fund credit facilities, and you could have this world where Bitcoin-based credit backs even non-Bitcoin activities. That is a wildly ambitious vision, but I don't think it's totally impossible. And what's interesting is, like, Bitcoin's really the only thing that has a shot at achieving that point blank period. Like, no other crypto asset or digital currency, whatever you want to call it, has the pristine nature or the size of Bitcoin to really kind of usurp something like treasuries in this market. So, um, all right, that's kind of this like grand vision, but from like a 30,000 foot view, high level. Hopefully, it made sense to everyone. In the next chapter, we're going to be covering DeFi. We'll kind of start at the very earliest innovations of DeFi and show how it's evolved into something a bit more credible today. We'll also be very transparent about where it's kind of hit a ceiling and where the limitations are. And then that should set the stage for the rest of the series. So, yeah, make sure you tune in for chapter 2. And I hope you enjoyed this. Thanks.